Coming up on Market to Market. Tempers flare over the Keystone XL pipeline. Wind energy advocates see their best year really was blowing in the wind. And while snow and rain whip the Midwest, chances of leaving the drought behind improve only slightly. Those stories and market analysis with Elaine Kub next.
Funding for Market to Market is provided by DuPont Pioneer, working with growers to match the right product to the right acre. Science with service, delivering success. This is the Friday, April 19 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. It was a rough week in the markets. Stocks and commodities suffered when China's GDP came in below market expectations. Closer to home, a new AP GfK poll shows 3 in 4 Americans are pessimistic about their financial future. Despite the cynicism, other benchmarks indicate signs of growth, reinforcing the belief that the beleaguered economy continues to improve. According to the Commerce Department, the overall pace of home construction rose 7% in March. At this speed, U.S. contractors would build more than 1 million new units this year. The figures for March are more than 45% higher than the same month a year ago. Applications for building permits, a measure of future construction, declined nearly 4% to an annual rate of just over 900,000 in March, down from the previous month's brush with a 5-year high. Despite the encouraging recovery news for builders, those trading on Wall Street have been on a roller coaster ride. After the Dow failed to break the 15,000 mark last week, the market fell 3 out of 5 sessions, dropping more than 315 points this week. Gold bugs also took it on the chin this week as the price per troy ounce suffered its sharpest fall in decades. The precious metal had been a good investment for the past 10 years and hit all-time high of $1,920 an ounce in 2011. As metal softened, the bears flushed the bulls out of the oil market. Slightly lower than expected growth in China and reduced gasoline demand pushed black gold down 4% this week. At a little more than $88 per barrel, work to reduce reliance on foreign oil remains a priority from Capitol Hill to those using gas pumps across the nation. Tapping alternative crude sources like Canadian oil sands would appear to be a no-brainer where energy independence is concerned. Canadian oil giant TransCanada's controversial XL pipeline is expected to send 800,000 barrels of oil per day to U.S. refineries. And while the promise of energy independence would appear to be a good reason to give the 1,700-mile-long project a green light, grassroots organizations disagree.
At 830,000 barrels per day at 2% is 16,600 barrels per day leaking undetected in my water, on my property.
Emotions ran high this week in Grand Island, Nebraska, where the U.S. State Department held its sole public hearing on the environmental review of the proposed Keystone XL pipeline.
We feel this would be very important for this project that has really garnered an enormous amount of public interest.
Calgary, Alberta-based TransCanada Corporation is set to deliver oil sands crude from surface mine operations in Canada to refineries in the Gulf of Mexico. The oil company's original route was rejected by both the Obama administration and the state of Nebraska early last year due to its potential negative impact as it traversed Nebraska's sandhills. The region is seated atop the massive Ogallala Aquifer, which underlies parts of 8 states. The Cornhusker State relies on this resource for ranching, agricultural irrigation, and drinking water.
We have no idea how tar sands will react in the Ogallala Aquifer, which is a unique water system. We have no idea how it's going to react in the Platte River, the Niobrara River, or Families Wells. We think that basic science has got to be done before they move forward with this type of project.
Portions of the Keystone XL pipeline running through the U.S. have already been approved, and construction is moving forward. Nebraska's section represents the final hurdle for infrastructure that proponents say would bring increased energy security and put more Americans back to work.
Well, I see the project itself is going to create thousands of jobs. This is similar to any other construction project. One of the points made by opponents is, well, how many permanent jobs will there be? But yet, with every highway or bridge or road construction, it's about construction jobs. It's part of what we need to move our economy forward.
In 2012, TransCanada suggested a new corridor that largely avoids the sandhills. Finding the revision agreeable, Nebraska Governor Dave Heineman approved the new pipeline route through his state in early 2013. Coupled with State Department findings in March that the route would have no significant impacts to environmental resources along the route, the final decision on the pipeline likely belongs to the president. Last week, Alberta Premier Alison Redford stated that if the Obama administration rejects Keystone XL, it would represent a significant thorn in Canadian-U.S. relations.
30% of U.S. oil imports now come from Canada. Without Canada's almost 2 million barrels a day from the oil sands, there is no prospect of North American energy independence. It makes economic and environmental sense to get that energy from a trusted partner.
I mean, look, incredible, and that is oil.
But a recent pipeline oil spill in Mayflower, Arkansas has served as a lightning rod for those opposed to Keystone XL's completion. Critics claim pipeline leaks are inevitable, yet GOP lawmakers are moving forward in their quest to make Keystone XL happen, pointing out that thousands of miles of pipeline already exist within the state of Nebraska. Congressman Lee Terry last week introduced House Resolution 3, the Northern Route Approval Act, which aims to circumvent the Obama administration's authority over the decision.
So here we are, April 2013, still mired in the process. My bill, H.R. 3, puts an end to that. The bill declares that no presidential permit shall be required for the project. The additional provisions of the bill will ensure the pipeline is built.
Public backlash against the project may all be for naught, but Nebraska farmers, ranchers, and environmentalists are sure to fight for their cause well into the future. A final decision is expected from the president this summer. That is, unless Congress is successful in legislating that power away from the administration and proceeding with the project for better or worse. There has never been a lack of good ideas when searching for ways to reduce America's addiction to oil. Ethanol, wind, and solar energy have all moved beyond being idle curiosities to mainstream realities. Ethanol got its boost with the blender's tax credit that expired at the end of last year. The industry is on track to fulfill its federal mandate thanks to favorable policies. Solar has experienced an expansion of its own. According to the Solar Energy Industries Association, since the enactment of the Solar Investment Tax Credit, domestic use of solar panels has increased 12-fold. The cumulative solar capacity in the U.S. now exceeds 7,700 megawatts, enough to power more than 1.2 million homes. And wind energy production has had a banner year, as everyone from manufacturers to installers got a lift when the wind energy tax credit was reinstated. It has made those who have anything to do with the industry realize the futures look bright every time the wind blows. According to the American Wind Energy Association, or AWEA, the nation's wind industry saw record-breaking growth in 2012 as a power provider. American wind power generation rose 17% last year and produced more than 10% of the electricity in 9 states, up from just 5 states in 2011. AWEA officials say wind power was the #1 source of new generating capacity in 2012. Iowa ranked first with nearly 25% of its electrical power generated by the wind. South Dakota was a close second at nearly 24%. Experts say the positive numbers are likely to continue rising as new investments and wind projects are started. Nationwide, wind energy produced 3.5% of America's electricity in 2012, according to the Wind Energy Advocacy Group's latest figures. AWEA officials say U.S. wind farms are generating enough clean, affordable energy to power the equivalent of almost 15 million homes. Overall, the U.S. wind energy industry had its strongest year on record in 2012. The industry built more than 13,000 megawatts of electric generating capacity and leveraged $25 billion in private investment to complete turbine construction. Statistics provided by the agency show that for the first time, wind became the #1 source of new U.S. electric generating capacity, providing 42% of all new electrical generating volume last year. Renewable energy as a whole accounted for over 55%, of all domestic generating capacity in 2012, with wind providing over 60,000 megawatts of cumulative power. The building boom was spurred in January when lawmakers passed legislation that included the long-sought extension of wind energy tax credits, after having allowed it to lapse at the end of last year. Congress also changed the rules so projects only have to be under construction by the end of 2013 to qualify for the tax break rather than be fully operational.
Next, the market-to-market report.
Farmers and ranchers try to take control over as many factors of production as they can. But even after centuries of trying, they still have no control over the weather. After last year's drought, it appeared there would be no relief for many as this year's planting season got underway. In a strange twist of fate, the nation was hammered by severe weather this week as rain, ice, and snow hit everywhere from the mountains to the Atlantic. Some regions went from bone dry to flooded in a matter of days. The calendar says spring, but Mother Nature continues to disagree. Heavy snow fell in the plains, most recently in Nebraska and Minnesota, where travel was slowed because of the precipitation. North Dakota's capital of Bismarck was again in the middle of a winter wonderland. More than 17 inches fell on Sunday, breaking an all-time single-day snowfall record. More snow dropped from the sky as the week progressed, with even more precip in the forecast. This is as some residents continued preparations for predicted flooding around Fargo. More snow fell in portions of Wyoming and Colorado as a 150-mile stretch of Interstate 80 was shut down. Limited visibility hindered the ability of road crews to keep up with the storm. April is the second snowiest month for Colorado, and the storm this week added to the monthly total. The moisture also helped boost mountain snowpack, which provides most of the water supply downstream. The depth of mountain snow in both Colorado and Wyoming is below average, but has risen in the last week to 77% of average in both states. The moisture also helps relieve drought stress in Colorado. As mentioned in this week's drought monitor from the University of Nebraska, conditions improved almost 5 points in the contiguous United States. Widespread rain soaked much of the Midwest for the second consecutive week. Thawing has increased, allowing for the falling precipitation to soak into the ground and recharge depleted soils. Iowa's climatologist reported that the past 7 days were the wettest in statewide average rainfall since June of 2010. Drought battles are giving way to flooding ones. High water is quickly appearing in portions of the Corn Belt. Several single-day rainfall records fell in Iowa and Illinois. Stream flows are in the upper 90th percentile, resulting in some small and urban flooding. Portions of the Mississippi River could be at or above flood stage in a matter of days from the Quad Cities to St. Louis. Dredging crews spent much of the winter clearing low portions of the channel. Now the water could be 3 or 4 feet above flood stage. Rainy weather is hamstringing spring farming. USDA's latest snapshot of corn planted reveals the lowest completion rate since 2009, with only 2% of the corn in the ground. The 5-year average is 7%. Last year at this time, 16% of the crop was in the ground. This week, cold and wet weather, traders unwinding positions, a change in Chinese demand for corn, and a South American harvest on track to produce a record crop served to move the markets. For the week, May wheat lost nearly 6 cents, while the nearby corn contract moved 7 cents lower. Soybeans rallied again this week as the May contract posted a weekly gain of 15 cents. Nearby meal prices followed suit, adding $12.30 a ton. In the softs, cotton trended lower as the May contract posted a weekly loss of $2.10 per hundredweight. In the dairy market, May Class 3 milk gained 88 cents, while the June contract moved 29 cents higher. Over in livestock, the June cattle contract rallied 55 cents. Nearby feeders lost $1.72, and the June lean hog contract moved 30 cents higher. In the financials, the euro lost 19 basis points against the dollar. Crude oil lost $3.28 per barrel. COMEX gold declined by $105.80 per ounce, and the Goldman Sachs commodity index lost more than 17 points to settle at 624 even. Here now to lend us her insight on these and other trends is one of our regular market analysts, Elaine Kub. Elaine, welcome back.
Thanks for having me.
It has been a busy week this week. It all started on Monday. We saw a massive sell-off across the board. Talk to us a little bit about what happened.
Well, I could say that it actually started the Friday before because that gold sell-off really started on that Friday. And there's a number of things that could have been the spark for that. Whatever it was that happened, somebody was short selling a lot of gold. The volume of selling was very high, and it just sort of, really scared a lot of folks, I think, into not having any particular reason to stay long in gold. Like, this was a good opportunity to liquidate your positions. And when those margin calls came in for gold, I think a lot of funds ended up selling out of other commodities as well, and grains got hit in this big problem. And the thing about gold is it's not like grains where you know that there's an economic value to turning it into ethanol or turning it into livestock feed. It's only worth what people think it's worth, so it's really susceptible to these kinds of fluctuations, and that's true of all currencies. And there was, the yen was moving around, the UK got downgraded just today on Friday. So there's a lot of these fluctuations that could still come in the next weeks or months.
So this is going to continue to be a bearish factor, do you think, on the market as a whole, or moving forward, will it be mostly confined to the metals, the downgrades and the fluctuations in currencies?
The volume of trading in gold specifically and silver and these precious metals did quiet down completely through the rest of the week. And here on Friday, they did sort of aggressively try to have a recovery, but it failed miserably. I mean, I think gold is kind of stuck. I don't know that we're going to see gold go back to its $1,900 highs of a while ago. So I think that story is pretty well quieted down for gold. But the idea that funds or anybody can just, be very risk averse and want to sell out of them very suddenly, that can absolutely happen to the grains. And I think we did see that in corn on Thursday. One little headline about the Renewable Fuels Association or anything, which was not even necessarily bearish for ethanol so much as it was bearish for biodiesel. All it takes is one headline, and I think a lot of traders are looking for any excuse, particularly these large funds are looking for any excuse to just take risk off the books.
Just get out, get what they've got, and move on, find something perhaps more profitable.
Right.
Well, let's take a look. As you mentioned, grains, we had a big week for folks out in the fields this week.
Yeah.
We saw, well, it wasn't a big week. Yeah, I guess that's a better way to look at it. What is this delayed planting, and we're on April 19th, as we look to this planting getting delayed more and more, what impact is that going to have moving forward, do you think, on the commodities in general?
Well, when you look at the new crop prices or even the spring wheat prices, the traders, the market does not really seem to be too concerned about it yet. And for the past couple of weeks, I've been sort of in that camp saying that as long as you get corn planted by May 15th is really the date that agronomists worry about yield losses from that point forward. So as long as, and it can be planted very fast. We've demonstrated that over the past couple of years, that once farmers get in the fields, they can plant very fast. So like I said, for the past couple of weeks, it's been, don't worry, just wait. It's not as far behind the 5-year average as it is behind 2012's very early pace. But I'm just about ready to hit the panic button on it now, because when you look at the 6 to 10 day forecast, Illinois is still got rain in the forecast. So when are they going to be able to dry out before May 15th? Iowa is still very cold. So when is their soil ever going to be able to warm up before May 15th? So there are these things. And there's also the consideration that the prices, when we're looking at corn, the prices for the September contract are 25 or 35 cents higher by the time you include basis. So the motivation to get planted early was very strong, and the window has pretty much been missed for planting corn that could be harvested in September and get those really high prices.
Well, and you mentioned cold weather. That's been on the minds of a lot of folks, especially farther west. In wheat country, we've had a couple severe freezes, and I think another one in the forecast for next week for a lot of wheat country. What impact has this freeze had on producers and the markets? Have we seen any impact?
Yes, absolutely. So the freeze damage was serious. The wheat was heading, and it was maturing, and the areas that froze were certainly affected. I was surprised by how little effect it had on the overall condition ratings from the USDA in their weekly crop progress report. And I think part of that is the crop progress report is sort of a windshield tour of what it looks like. And some of the worst ratings right now are still in South Dakota just because it's not green yet. So I think as we go forward, there's the potential for any green wheat acres to sort of hide the damage of some lost frozen acres. And there's also the consideration that wheat fields that get torn up or burned down and planted to something else and abandoned, those will get missed on the condition ratings. So I don't know that the market is going to receive a confirmation really of that freeze damage, other than just the anecdotal evidence that you hear from folks who are actually seeing those frozen fields. So like I said, the market really has not responded to that, or maybe it has and it's just been counteracted by the wider commodity sell-off. But wheat has been pretty flat.
Well, and with that in mind, what is your forecast for wheat? Where do you see prices headed?
Well, let's talk about spring wheat real quick also, because that's another situation where fundamentally you can say it's not been planted. Its planting is 10 to 15% behind pace probably by the time Monday comes around. And its prices are at about $8, but your break-evens may be above $8. So my recommendations, if I had wheat to sell or if I was a wheat producer, I would not be selling any right now unless I had it planted or unless I knew it was going to make it through these freezes. So I think that fundamentally there are bullish things at play for wheat, and we just have not seen them built in yet.
And on winter wheat, you think prices are going to be hovering in this level until we get sort of a demand shock?
Yeah, I think exactly. The chart is pretty flat. There's not a lot of reasons to see it going, above the $720 level until you have corn going up, because the cash feed wheat market is actually only about 20 cents higher than the average cash price of corn. So that means that there are still regions, particularly in the east, where wheat is still going into the feed rations, which means that wheat and corn are going to stay married price-wise going forward here.
Well, let's talk about corn. As we look at what's happening in the old crop market, where do you see prices going? I mean, how is the demand situation looking, the situation on the Mississippi River? What issues are going to play into old crop corn prices in your mind?
What's been really interesting over the past few weeks is to see some ethanol. Actually, production has been coming up. The stocks have been coming down. You could get some optimism for ethanol and for corn use in ethanol. And you could also look at that chart and see that gap to the upside that's still open between 680 and 695. But the market has showed no particular interest in going up and filling that gap yet. So I think you can't get too excited about corn moving very far one way or the other unless it breaks through either 625 on the downside, because honestly, we know that there's a shortage of corn in this country and that it needs to be used for ethanol and for livestock feed. So I think there's a minimal downside risk unless something strange happened to the dollar. So I say if you see it go below 625, something's happening and you should be concerned.
Be nervous.
Or if you see it break through that 680 and start heading back to $6.95, $7, I think that's what a lot of farmers are looking for if they've still got some old crop corn sitting around that they're really want to get a high gambling price on.
All right, look for that $6.95, $7 if we break 680.
Yeah, if we can.
Taking a look at new crop with the delayed planting, potential that's out there and prevented planting acres, when is the market going to take that into consideration?
That's a really excellent question, and I really want to see, I want to see confirmation that the trade is paying attention to these late planting concerns early this next week, either in the crop progress report that comes out on Monday afternoon or within the next week or so. And if that, doesn't happen, if we don't work some sort of bullish enthusiasm into that, you have to wonder if it's a kind of a gold situation where if a market is not going up, it's going down. So I'm still bullish for old crop corn, and I'd like to see it, move up to the $6 level, for instance, before I'd be really interested in selling a very large portion of my production. But I think it's in a precarious position, and I just don't know what it's going to take to make the market be more concerned about this late planting. Last year they were willing to be bearish about early planting, which doesn't really make any difference because you don't get extra yield by planting early, but you can lose yield by planting late. So it would seem more legitimate to me as a fundamental argument to be bullish about late planting, and that may certainly happen here in the next couple of weeks if it doesn't dry out. Particularly,
you're right, if it stays wet and cold.
Yes.
Now let's look at soybeans. How have soybeans been holding up on the old crop side as we look at demand from China and other places? What are we seeing in the soybean market?
Yeah, the soybean market has been the one star of the grain sector. It's been rallying this past week or past 2 weeks. And the demand from China is one of those reasons because there are still these bottlenecks in Brazil that they can't move it out of there. And what's interesting about that is that I think the industry has been assuming that we could ship all of the old crop soybeans out of the U.S. And then if the U.S. industry still needs soybeans, perhaps we would import them from Brazil, which makes a certain amount of sense, particularly when you look at ocean freight rates are still quite cheap in historical terms or cheaper than a year ago. But if it's bottlenecked in Brazil for China to get cargoes out, how are we going to get cargoes out? Are we just kicking the can down the road for these supply shortages just a few months down the road? So I think the soybean market could kind of keep this story, even though we have a large South American crop exists. It exists. the market doesn't have it. And meanwhile, the domestic crush ratio has really quite improved over the past week. So, I mean, there's a lot of reasons why you can see that rally in the old crop soybean market right now.
So advice to producers with soybeans in the bin, hang on to it, continue to ride this rally, you think, or where do you see it going?
No, I have not been bullish for old crop soybeans for the past couple of months just because the South American crop exists. And when you look on a supply and demand chart, the major bullishness of scarcity of supply is really not there anymore. So it's more of a localized concern or just a short-term concern. And if you could see a $14.50 price again, I would definitely be a seller.
All right, now taking a look at new crop, what are your thoughts there?
I should correct that to say $13.50. Yes, new crop.
Well, if you get $14.50,
hey,
definitely,
take that too. But new crop again has been like corn that has not really been responding to these same concerns or to the planting concerns, particularly when you look at the relationship between the corn and soybeans. If the market believed that corn planting was going to be late, they should believe that we would be getting extra soybean plant acres as acres get switched. But largely on a day-to-day basis, that does not seem to be the case. It seems to be, divorced from that reality. So soybeans, I'm looking for a $13.50 price for new crop soybeans, and it's sort of arbitrary because there's no reason to look at the chart and expect that to happen. That was the February high, and it would be, a 2.2 ratio over $6 corn is really why that's a goal of mine.
All right, let's real quick take a look at livestock. We had the cattle on feed report today. We saw feeders sell off earlier. Live cattle are rising. Give us a quick thought on the cattle markets.
Well, the cattle industry is in a really ugly scenario right now, and there's just no denying that. The packer margins were already poor, and they got poorer this past week. The feeder margins for cattle are the worst of anything in the entire livestock industry is the feeder margins. And meanwhile, if you look at the prices that are at the grocery store, they're at an all-time high. So you expect to see some of that passed on, but it has not really been able to be the case just because of the high feed costs.
All right, well, thank you so much, Elaine, and we'll talk hogs during the Market Plus segment. That wraps up this edition of Market to Market, but if you'd like more information from Elaine on where these markets just may be headed, visit the Market Plus page at our website. You'll find expanded market analysis, audio podcasts, and streaming video of our program, as well as links to our Twitter feed and Facebook account, all free at the Market to Market website. Be sure to join us next week when we'll examine the impact of heavy spring rains on nitrogen levels in Midwestern fields. So until next time, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by DuPont Pioneer, working with growers to match the right product to the right acre. Science with service, delivering success.